For years, the idea of $100 silver has lived in a strange space inside the financial world. To some investors, it has always sounded inevitable, a delayed outcome of monetary policy and structural scarcity. To others, it has sounded almost mythical, like one of those predictions that resurfaces every few years but never quite materializes. Yet recently something unusual has been happening in the silver market. The resistance that once seemed constant, the heavy pressure that repeatedly pushed prices down, appears to be fading. And that raises a question that more investors are beginning to ask quietly. Why do the banks seem less interested in fighting silver now? To understand why this shift matters, you have to step back and look at the bigger financial landscape in which silver exists. Precious metals rarely move in isolation. They are deeply connected to the broader forces shaping the global economy. Interest rates, currency stability, liquidity cycles, and the psychology of investors navigating uncertainty. For much of the last decade, the environment was not especially friendly to silver. Interest rates were relatively stable, inflation was contained, or global markets were dominated by risk-on behavior. When investors feel confident in stocks, technology growth, and expanding economies, metals like silver tend to lose attention. Capital flows toward assets that promise faster returns. But the macroeconomic backdrop has changed dramatically in the last few years. Central banks around the world unleashed unprecedented levels of liquidity during the pandemic era. Governments expanded fiscal spending. Supply chains fractured. Inflation surged to levels not seen in decades. And suddenly, the stability of major currencies began to feel less certain than it had in a generation. This is the kind of environment where precious metals start to regain relevance. Gold usually moves first in these cycles because it is seen as the ultimate monetary hedge. But silver occupies a unique position that makes its long-term dynamics particularly interesting. It is both a monetary metal and an industrial one. That dual identity means its price is influenced not only by financial stress, but also by technological demand. Solar panels, electric vehicles, advanced electronics, and emerging energy infrastructure all require silver in ways that many investors underestimate. In fact, the metal plays a crucial role in electrical conductivity, and modern energy systems increasingly rely on it. So while financial investors often focus on silver as a store of value, industry quietly consumes enormous amounts of it every year. And that brings us to the supply side of the equation. Unlike gold, which is often mined specifically for its own value, a large percentage of silver production comes as a byproduct of mining other metals such as copper, zinc, or lead. That means silver supply cannot easily expand in response to rising prices. If industrial demand surges, miners cannot simply open dozens of new silver mines overnight. This structural constraint has been building pressure beneath the market for years. Now add another layer to the story: the role of large financial institutions in the precious metals market. For decades, major banks have been deeply involved in trading and market-making activities in metals futures markets. Their presence provides liquidity and helps stabilize price discovery, but it has also led to persistent debate among investors about whether large institutions have historically suppressed price volatility in silver. Without stepping into speculation, what we can observe objectively is that silver markets have often experienced significant resistance near key price levels. Large short positions in futures markets have periodically acted as a form of pressure whenever prices attempted to accelerate upward. However, the landscape around these positions appears to be shifting. Recent market data suggests that institutional positioning is evolving. Banks that once carried large short exposure have been gradually reducing those positions over time. This does not necessarily mean a coordinated strategy or a dramatic reversal, but it does signal that the risk profile of betting against silver may be changing. Why might that be happening? One possibility lies in the broader interest rate cycle. When central banks raise interest rates aggressively, holding non-yielding assets like precious metals becomes less attractive compared to interest-bearing alternatives. But as the global economy slows and policymakers begin to consider easing financial conditions again, that dynamic can reverse. Lower interest rates reduce the opportunity cost of holding metals. And when that shift occurs at the same time inflation remains elevated, precious metals tend to regain momentum. Another factor involves currency dynamics. The global financial system still revolves heavily around the US dollar. When the dollar strengthens significantly, commodities priced in dollars often struggle because they become more expensive for international buyers. But if the dollar begins to weaken or stabilize after a strong cycle, commodity markets often benefit. Silver, being one of the most liquid precious metals, tends to react strongly to these currency shifts. Then there is the role of investor psychology. Markets are not driven purely by mathematical models or supply-demand spreadsheets. They are also shaped by collective narratives. The story investors believe about an asset can influence the flow of capital into or out of that asset. For many years, the dominant narrative around silver was uncertainty. It was seen as volatile, unpredictable, and frequently manipulated by short-term trading flows. But narratives evolve. If investors begin to view silver not only as a speculative metal, but also as a critical industrial resource for the energy transition, the perception of its value changes. Instead of being treated like a volatile cousin of gold, it begins to resemble a strategic commodity with structural demand. That narrative shift alone can transform how capital enters the market. Another important layer involves the growing interest of retail investors. In the digital age, information spreads faster than ever before. Communities of individual investors now analyze market data, discuss supply trends, and track institutional positioning with a level of detail that once belonged mostly to professionals. This democratization of financial analysis has made certain markets, including silver, more visible than they were in the past. But perhaps the most intriguing element in the current silver discussion is the possibility of a tightening physical market. Paper markets such as futures contracts can trade enormous volumes relative to the actual physical supply of metal. Most of the time, that structure works smoothly because participants settle contracts financially rather than requesting delivery. However, if industrial demand continues to grow while investment demand rises simultaneously, the physical side of the market can become more influential. When physical inventory tightens, price discovery can begin shifting away from purely financial speculation and toward real-world scarcity. This is where the concept of significantly higher silver prices enters the conversation. Reaching $100 per ounce would require a combination of factors aligning at the same time. Inflation expectations would likely need to remain elevated. Interest rates would need to move into a more supportive environment for metals. Industrial demand would need to continue expanding, particularly in energy and technology sectors. And perhaps most importantly, investor sentiment would need to shift toward recognizing silver as a strategic asset rather than a niche speculative trade. That kind of alignment does not happen quickly. Markets move in cycles, often taking years to fully reflect structural changes. Yet history shows that when silver does move, it can move very rapidly. The metal has experienced explosive price expansions in previous cycles when supply constraints and investor enthusiasm collided. What makes the current moment interesting is that the underlying drivers are not purely speculative. They are tied to global economic transitions. Energy infrastructure, currency stability, and the long-term consequences of expansive monetary policy. And this may help explain why large institutions appear less interested in aggressively opposing upward price movements than they once were. When structural forces begin shifting in a market, even the most sophisticated players adapt their strategies. Fighting a trend supported by macroeconomics, industrial demand, and changing investor sentiment can become increasingly risky. Instead, institutions often transition from resistance to participation. That transition rarely happens overnight. It unfolds gradually, almost quietly, through changes in positioning, hedging behavior, and liquidity provision. For observers watching the silver market closely, these subtle shifts are sometimes more meaningful than dramatic headlines. Because markets often reveal their intentions through behavior long before price charts fully reflect the change. So the question is not necessarily whether silver will reach $100 tomorrow or next year. Predicting exact price levels is always uncertain, especially in complex global markets. The more interesting question is whether the conditions that once kept silver constrained are slowly dissolving. If the financial environment continues evolving toward persistent inflation, strategic resource demand, and periodic currency instability, the long-term case for higher precious metal prices becomes increasingly plausible. Silver sits at the intersection of those forces. It reflects both the fears of investors seeking protection and the ambitions of industries building the next generation of energy and technology systems. And when a market exists at that crossroads, its future path can become surprisingly dynamic. For now, the signals emerging from institutional behavior, macroeconomic trends, and industrial demand are beginning to align in ways that deserve attention. Whether that alignment eventually carries silver toward dramatically higher price levels remains an open question. But the conversation surrounding the metal is clearly changing, and in financial markets, when the narrative begins to shift, price movements often follow sooner than many expect.